They told everyone this was just another rally. They said the situation was under control. They insisted the system was functioning normally, that commodity markets were orderly, that pricing distortions would correct themselves, and that nothing serious was happening beneath the surface. And then, without warning, trading stopped. Not in one isolated product, not for a brief technical pause, but across multiple commodity investment vehicles, all at once. Several commodity funds were abruptly frozen in a single trading session. The only regulated investment vehicle providing direct exposure to silver futures in the entire domestic market was shut down for the full day. Multiple energy-related funds were halted simultaneously. And yet, most people scrolling through headlines never even noticed. That is what makes this moment different. This was not routine volatility. This was not a software error. This was not a minor regulatory adjustment. It was an emergency intervention. Regulators stepped in explicitly to prevent what they described as systemic risk and the potential for widespread investor losses. When authorities are willing to halt trading across multiple commodity vehicles because price distortions have spiraled beyond control, the message is clear. The system was under strain. And when the second largest economy in the world begins forcefully slowing commodity trading due to runaway premiums, it is no longer a local issue. It matters far beyond national borders. It matters for silver. It matters for gold. It matters for energy. And it matters for anyone holding hard assets in an environment where long-held assumptions about stability are quietly being questioned. To understand why this happened, and why it matters, it is necessary to examine the details carefully because much of the surface-level coverage has ignored what truly drove these actions. On the day in question, financial authorities implemented coordinated trading suspensions across several commodity-focused investment funds. The most significant action involved the only publicly accessible investment vehicle that provided direct exposure to silver futures through regulated channels. For investors seeking silver exposure through traditional fund structures, there were no alternatives. This single vehicle was the gateway. Trading was suspended for the entire session. Not briefly, not conditionally, completely. Even more telling was the fact that this was not the first such action. A full-day suspension had already occurred just over a week earlier. Whatever measures regulators believed would stabilize conditions had clearly failed. The pressure returned, and it returned with enough force to justify another shutdown. At the same time, multiple energy-focused funds were halted simultaneously for shorter durations. Though each suspension lasted roughly an hour, the coordinated timing revealed something critical. This was not about isolated mismanagement or individual fund stress. This was a system-wide response to a broader problem. That problem was premiums, specifically the growing gap between the price investors were paying for fund shares and the actual value of the underlying assets those funds were supposed to track. This distinction is crucial. When an investor purchases shares in a commodity fund, the expectation is that the share price will closely reflect the value of the underlying commodity exposure. In this case, that exposure consisted of futures contracts tied to silver prices. Under normal conditions, small discrepancies between share price and asset value are expected. Markets are imperfect. Friction exists. But when that discrepancy reaches extreme levels, the structure begins to break. In this instance, investors were paying more than one-third above the actual value of the underlying silver exposure. The premium had reached approximately 36%. That is not normal market behavior. That is desperation. To put this into perspective, an investor purchasing at such a premium would suffer an immediate and severe loss if the premium merely returned to historical norms, even if the underlying silver price did not decline at all. These buyers were not paying for silver itself. They were paying for access. They were paying for momentum. They were paying to avoid missing out. This is precisely the type of behavior regulators monitor most closely. They saw retail investors flooding into a constrained structure at unsustainable prices, driven by fear of being left behind rather than rational valuation. They understood that once momentum slowed, or reversed, the losses would be swift and severe. So they intervened. Not to suppress silver, not to manipulate prices, but to break a feedback loop that had become mathematically untenable. Some observers dismiss such actions as heavy-handed regulation. Others frame it as excessive control or overreaction. But that interpretation misses the broader context entirely. What unfolded was not an isolated event confined to one market or one country. It was a symptom of deeper forces reshaping global commodity markets. Silver had been moving aggressively higher. In roughly 1 month, prices surged by more than 50%. Gold followed closely behind, climbing sharply toward levels that would have seemed implausible not long ago. Energy prices also broke through key technical thresholds, reaching multi-month highs. These moves did not occur independently. They were driven by a convergence of forces that mainstream narratives often treat separately, but which are deeply interconnected. The first factor was monetary uncertainty. Markets have been caught between expectations of easing financial conditions and concerns that restrictive policy may persist longer than anticipated. Each shift in expectations sent currencies, yields, and commodities swinging violently. When investors anticipated easier conditions, the purchasing power of currency weakened and real yields compressed, conditions historically favorable for precious metals. When those expectations reversed, volatility surged. This back-and-forth amplified leverage-driven strategies and magnified price swings within fund structures already under strain. The second factor was geopolitical tension. Rising conflict risk, particularly around key energy corridors and strategic regions, introduced uncertainty into global supply chains. Energy markets began pricing in potential disruptions. Investors seeking protection against geopolitical instability turned toward commodities traditionally viewed as stores of value. That influx of demand collided with limited investment channels. The third factor, and perhaps the most underappreciated, was structural supply pressure. Silver is not merely a financial asset. It is a critical industrial input. Modern technologies rely heavily on it. Renewable energy infrastructure depends on it. Electrification initiatives depend on it. Advanced communications infrastructure depends on it. Demand growth has been steady, while supply expansion has lagged. When monetary demand, safe haven demand, and industrial demand converge simultaneously, price pressure becomes inevitable. And when that pressure is funneled through a narrow set of financial vehicles serving a massive investor base, distortions appear quickly. This leads directly to the psychology driving the market. Retail investors, regardless of geography, tend to follow trends. Momentum attracts attention. Attention fuels inflows. Social narratives accelerate the process. When prices rise rapidly, the fear of missing out becomes a dominant force. What differentiates this environment is concentration. When a vast population has access to only one primary vehicle for a specific type of exposure, demand becomes compressed into a single structure. That structure cannot expand quickly enough to absorb the flow. Premiums widen. Momentum accelerates. The cycle feeds on itself until it breaks. This is where regulators step in, not to stop the trend, but to prevent catastrophic outcomes for participants who entered late at unsustainable prices. A useful analogy is that of overcrowding. When demand exceeds capacity, prices rise sharply. People pay far more than fair value simply to gain entry. But when conditions change and everyone tries to exit at once, losses compound rapidly. That is what extreme premiums represent in volatile commodity funds. The implications extend beyond domestic markets. When access is restricted, demand does not vanish. It reroutes. Some flows shift toward physical assets. Others seek alternative financial channels. Some spill into adjacent markets, such as gold or international instruments. This redirection influences global pricing dynamics. One indicator reflecting this shift is the relationship between silver and gold prices. As silver outperformed, the ratio between the two compressed to levels not seen in many years. Historically, such compression often signals a transition phase, sometimes leading to overshoot before correction. At the same time, physical demand surged. Sales of small-denomination silver products increased dramatically. Larger bars saw even greater percentage growth. Search interest related to acquiring precious metals spiked. This was not isolated speculation. It reflected a broader reassessment of financial security and asset reliability. However, momentum cuts both ways. Markets that rise rapidly are vulnerable to sharp pullbacks. Volatility is not selective. The same forces that produce rapid gains can produce equally rapid declines. Bold price targets often appear near emotional peaks rather than structural beginnings. This does not invalidate the long-term thesis, but it does demand caution. Participants already positioned may benefit from managing exposure rather than adding aggressively. Those not yet involved may find better opportunities during periods of consolidation rather than chasing extended moves. This distinction between accumulation and speculation is critical. The dynamics observed in energy markets reinforce this point. The coordinated suspension of energy-focused funds occurred alongside price breakouts and heightened geopolitical risk. The pattern mirrored what was happening in precious metals: rising prices, momentum-driven inflows, expanding premiums, and regulatory intervention. This sequence follows a familiar pattern. Geopolitical tension rises, commodity prices respond, retail participation accelerates, fund structures strain, premiums expand, authorities intervene. Intervention addresses symptoms, not causes. Underlying demand remains. Structural vulnerabilities persist. Market forces continue building pressure beneath the surface. This is why the story does not end with trading halts. The broader takeaway is not fear, but awareness. When authorities intervene aggressively, it signals that market dynamics have exceeded the capacity of existing infrastructure. That does not imply the trend is wrong. It implies the trend is powerful. Historically, major commodity bull markets have been punctuated by periods of intervention and volatility. These pauses do not negate the underlying forces driving repricing. They reflect attempts to manage the speed of adjustment. What matters most is what comes next. In the near term, volatility is likely to persist. Redirected flows will seek new channels. Price discovery will continue under constrained conditions. Short-term moves may be sharp and emotionally charged. In the medium term, outcomes will depend on whether the forces driving demand remain intact